What's happening? Hopefully the internet and computer and everything holds in today. I'm not going to turn on the YouTube on my end. I mean, YouTube's running, but I'm not going to go to it. So if anybody is able to copy and paste questions into the VTF for me, I'd appreciate it. Just trying to minimize the amount of things I have going on with the computer here to help make it run properly, and hopefully everything's okay today. I guess let's jump in. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of Intercipic. While my trades are placed through T3 Trading Group, you should carefully consider whether trading is suitable for you in light of your own financial condition. I got out of S today into the close. That name has just been the name that keeps on giving for me. It's been such a great trading vehicle. It's like my perfect type of stock that I look forward to trade. It cheap-ish from a price perspective, trades around $17 or so, but it's liquid enough to be able to trade, but thin enough where it moves. It's like perfect. I'm like a SoFi that's it's cheaper, but it's so thick that it can't even move, or Snap, it's like so thick it can't even move, or SSYS that I'm in, which can move a little bit, but it's too thin, so it's a little tougher to trade. That S is like a perfect trading vehicle, and I like the company also. So I got out of that, and I got into BABA today, which I didn't take a lot of size, but it still paid me pretty well despite having relatively small size. So let's go over to the charts. Boring day today. The title of today's YouTube video is a shout out to Neil Young. If there's any Neil Young fans out there, keep on ranging in the free world. I'm just running out of things to say about this range that the market's been in. We've got ranges within ranges within ranges. Today was just an absolute nutter range for the S&P. The SPYs here, you can just take a look at the chart for yourself. Nothing going on. Real tight range between 412 and 410 all day. We really held that 410 support. There was a couple times I was getting a little bit nervous that it might break, particularly after this 10-15 failure. We were weak early on. The IWM was really weak. It was leading us lower. The Qs, of course, were strong. Came into this 410, tried to find some intraday support there, caught this bounce higher at 10:15, which is the right time for more of a 15-minute correction, which a 15-minute correction, you can look at a 15-minute chart to see it, but you can also see a 15-minute correction on a 5-minute chart by looking at the 21 EMA. The 21 EMA on a 5-minute chart is usually pretty close to where the 80 EMA on the 15-minute chart is trading. So we tried to break up above that 80 EMA on the 5-minute to give more of a 15-minute correction at 10:15, which is normal, and hold that 410 support. And then we immediately traded back down. I was like, ooh, that's not good. Maybe we're actually going to get a leg lower here, and this IWM is going to lead us down. And I really did not want to see the indices broadly lose yesterday's low, even though that wouldn't be the end of the world because we're still within our big picture support and resistance on the daily charts. But then, we tested, held 410 again, and worked our way back up. And then again, just a really boring afternoon, sticking within that 412-ish to 410 range all day. And at the end of the day, I got nothing to talk about with this daily chart. Ranges within ranges. Inside day within the middle of this big picture range for the SPYs. It seems like we're getting a little bit impatient. I know I'm getting a little bit impatient for a break. I really want this market to break in one direction or the other as we come out of earnings season. Because I said this in the morning when I was coming off the virtual trading floor radio, and Pat was hopping on around 11. The market has been giving us no real advantage right now. There's an advantage in understanding and studying relative strength and relative weakness, and that's helped. Understanding the relative strength has been coming into big cap tech and not fighting it has been decent. We've had an advantage because we've been in earnings season, and earnings season has given us names to focus on, trades to focus on that have been working and given us cash flow pretty much every day as long as you execute them well and you've got the right name selection for it. So that's been solid, but once we start really getting out of this week, earnings season starts to be pretty much over. I'm sure we'll still have a few companies reporting next week, but it's going to be much slower on the earnings front starting next week. And then we lose, one more thing that we can focus on when the market's not giving us an advantage, which is what you have to do. I know there was some chatter in the afternoon. Cold Smoke Brian was talking about how breakouts just, have been not working in this market environment. He's entirely correct. Breakouts are great in trending environments, and this is not a trending environment. This is a range environment. In range environments, what we talk about is when markets are usually looking best is when they're about to pull back, and when markets are looking worst is when they're usually about to bounce. And you ping pong back and forth between your support and resistance levels. And you want to come in on the other side of that. You want to come in and potentially short when we're up at those resistance levels, and buy when we're down at those support levels. Obviously, you got to always be careful because eventually, someday, this market's going to break out. I just don't know when, where that's going to happen. It could be tomorrow. It could be a year from now. I don't have a crystal ball. I can't tell you that information. But I do think we just need to continue to know our key levels. Know your key levels, and eventually when it breaks, we want to make sure that we're prepared for it and we can take advantage of it. Because when we do break, it could come very hard and very fast. Traditionally, the longer the consolidation period is that you're looking at, the harder the break will actually be. So we continue to be in the same environment where the SPYs are stuck in this range, the Qs because of the market cap heavyweights. Oh boy, Q chart's not working. You guys can still hear me, right? Anybody? Anybody? Good. Whew. I'm sorry about this. I'm really gonna make sure I get a new computer as soon as I get back to New York, but I can't do it till I get back. The Qs continue to be led higher by mega cap tech. It's been 7 stocks that have produced the entire gains for the S&P this year, and those 7 stocks are like, I don't know what the number is, but they're probably 60% of the Qs. So you can see that the Qs have been really working higher, and that looks great. And then you look at the IWM, and the Russell's just been kind of a constant disappointment. I was a little bit excited this morning when the KRE was trying to rally off lows that maybe the Russell here could go, and it just didn't. And it's still within the same area. We're above key support levels. We're below key resistance levels. So it's just not giving me anything to bite onto. But I think given this market range that we've been in, which creates trickier price action and takes away a certain degree of edge, I think that given that we've been in that, as a team, we've been doing a fantastic job focusing on the right names every day, focusing on names that are reporting earnings, and even today when this market did nothing, you look at the SPYs today and you're like, how could anybody make money? We had some really good trades. JD was a big focus for me. I discussed, continuation versus like 36 quarter in this thing. The low of the day is $36. You can look at the intraday chart here. Held that opening low around that 36 quarter. Went, never even broke it on that pullback. Closed decent. I got back involved in Alibaba. We discussed 85 being a really important level. I never got a ton of size in this BABA. I caught a decent sized move on it for having small size. So, the P&L was decent for me on it. But it's hard for me to buy these stocks when they're still very extended off that gap, because you don't really know, in my opinion, like what the right stop loss is. So there's really like a couple ways to do it. You could have just been buying off the open versus 85, looking for pure momentum, in which case you may have gotten stopped out. Or what I was doing is taking less size, but when I do that, I'm really planning on continuing to build in and kind of average down into at least this 84 quarter area as the ADMA catches up. So there's only so much stock I can take because I'm giving a lot of room. I think my first buy in Alibaba today was 85 quarter, so I was giving it at least 75 cents on that first buy. I added at 85. I was ready to add more at 84 and about 75 cents, which did not get filled. The low there on that pullback was 80.42, and then it just took off. There was definitely some things to like about these Chinese names today. I still think that they're incredibly cheap from a fundamental perspective, and we understand why they're incredibly cheap from a fundamental perspective, just because, well, We had that headline come out a day or two ago about the accounting stuff from like the U.S. government, I think, on Chinese companies, and the Taiwan situation has been a pretty big deal as well, which I think is, you know, that kind of broader risk that comes in on these Chinese names has enabled these things to be cheap. But there was a headline out this morning that these Chinese companies, I think Alibaba and JD were specifically mentioned, are looking to work within the guidelines of U.S. accounting rules and want to work with the U.S. on that. And also, I think we saw a headline, was it this morning? It was either this morning or yesterday, that China's looking to kind of reopen and get re-involved with Taiwan as far as trade goes. So that just all looks like positives to me. So these Chinese names had good technical breaks today, along with those JD earnings. I'm not sure when Baba reports. I probably should have looked that up, considering I kept some overnight. But this Alibaba 85, I remember being a really big level of resistance when I was trading the stock at the end of April. And I remember being a little bit frustrated on one of the days in which I was trading it that it couldn't clear above 85. So this morning, pretty much May 18th. Thank you. So this morning, when you're basically getting a breakaway gap above 18, and I felt it could be a secondary to JD, and I felt that there was good news on the name, it really wanted me to be involved in it, or I really wanted to be involved in it. So those are a couple pretty good trades there. I was, at the same time as I felt I did a pretty good job with those names and I managed my swing positions, I was really annoyed at myself at one point this morning for a couple of the trades that I really wanted to be involved in that I missed. One was KRE in the $36 area, which I mentioned in the morning meeting. This did not close well, so I probably would not have been able to keep it. But the opening trade here pretty much held 36 perfectly, pivoted off of it. You had some extension there. I think this is an inside 5 and up. And then you're a really strong price correction. You know, came into the ADMA, and I remember at 9:45 not being involved because I missed it, and watching it and looking at going to this ADMA and create this little 5-minute shooting star. I was like, okay, well, this is where the KRE, this is where the IWM should actually fail back down, so let's see what happens. And within 5 minutes, we were breaking new highs and getting more of a 15-minute correction, even though it was only 9:55. I thought that this KRE, when it broke higher here at 9:55 a.m., was actually looking phenomenal, and then it kind of just whimpered out. It just kind of just became a dud, did nothing for the rest of the day. So I missed that one. I was annoyed at myself. You know, whatever. Closed lows. It doesn't really matter the result of how it worked. The result is the process is what's the most important. So, missed it. And then the other one I was annoyed at myself about for missing was PayPal, which we had also communicated. I mean, this was my idea that I brought to the morning meeting. I'm really pumped that it seemed like a lot of you guys were involved in this, even as I missed it. This is a day 3 RDR type of situation in a stock that I think is a good stock, has a strong buyback, maybe didn't have the best earnings report in the world, so sold off on it, but probably even further selling came in from a technical perspective, because anybody who's bought this thing over the course of the last year, or really over the course of the last 5 years, I guess at this point, but over the course of the last year, it's been stuck heavily in this range. And this is a breakaway gap to the downside on an earnings report that puts all these people out of the money. So the fact that you get 2 heavy days of selling in a row makes sense on it. But as a company that I think is decent, that has a strong buyback with this degree of extension to look for that day 3 RDR was solid, and it worked like tremendously well. I remember I was watching this thing like a hawk at the open on the first 5-minute bar, and the first 5-minute bar held yesterday's low. Yesterday's low, or did it break it? Maybe I got my numbers wrong. Or there was a time when I was looking at it, it was probably within that first 5-minute bar. 78 cents is that low. I guess you can't even see it in the first bar. The first bar low was 71 cents. But there was a time in which I was watching it where it held like 81 cents or something like that as a low, so it never broke yesterday's low, and it started to bounce, probably all within that candle before actually breaking lows. And I never got involved in it. I wanted to keep an eye on it. Got overly focused on JD and Alibaba. Obviously, it's hard to capture everything you want to be involved in sometimes. And then by the time I typed it up, you know, probably 7 minutes later and really looked at it again, I felt like I missed it. I really wanted good pricing on this thing in order to be involved, because it could shake it. You know, the RDR thing is not perfect. I really like small time frame confirmation on the big time frame for that trade. And ideally, that can sometimes give you cheats on the small time frame as well, which can work out really well. So that low easily could have shaken out, putting in a low of 62.64, breaking yesterday's low by 4 cents, and coming back up. That could easily make a pivot high here, break lows, and still at the end of the day close well and still give you that RDR, but with shaking out the intraday. I've certainly seen that happen in the past. So I wanted to make sure I got good pricing. That low was 62.64. By the time I typed it up, it was above 63, and I really didn't want to come in and risk 50 cents in this. I wanted to come in and risk 10 cents on this position and have my risk covered. And it did pull back here at 950 to as low as 62.75, and you could take that as a buy versus that low. I don't really ever like that trade nearly as much. You can still get involved and you can still make money, but I think it's just bad execution, and execution is so key in the business. Good execution in trading is very often the difference between having a trade that fails where you lose nothing or even make some money in because you game planned it well and you got the risk covered and you took off a little bit more in that bounce. Good execution is the difference between that happening and then your trade fails and you lose nothing, which honestly is my favorite thing in the world. And taking the trade late, having a worse risk reward, having less stock if it happens to work, and then taking on a pure loss in something that would otherwise be a break-even trade or a win. If you got involved in this PayPal, back through 68 cents and had 10 cents worth of risk or less on this, and it gives you a pop that's up to 63.50, you get 80 cents worth of reward on 10 cents worth of risk or less. And then this thing comes down. If this thing breaks a new low here and that trade fails and you get stopped out and you lose money on it, it means that you are either absurdly greedy, in which case you need to check the premise of your game plan, or you executed extremely poorly. So I did see this thing pull back below $63, but I wasn't going to let myself really get in that trade that second time and potentially take something that should be, even if you're really greedy, a break-even trade or a winner, and turn it into a loser. So I ended up never getting involved in it. I'm really glad to see that some of you guys did, and I really hope for the people who did capture this that you kept a piece at least all day. And this is what I always want to talk about small time frame risk for big time frame reward. I think that that's really the key to bigger profits in the business. The key to big profits in the business is to catch really big moves on really big size. All right, let me make an obvious statement. The execution of that is obviously going to be significantly more difficult. But the way that I find you can do it is if you have these small time frame entries, and you don't often get a gift of 10 cents risk or less in a $63 stock that works as perfectly as this one did, but you don't need to get that gift very often if the trade works out perfectly, because you get that stock here, you book some real fast because you recognize it's a counter trend trade, you get your risk completely covered on it, maybe you take off even a little bit more to make sure that if this thing fails on a failed trade, you end up even potentially making some money. And then when this thing closes at 64 bucks, you say, all right, I'm going to swing some. Why am I going to swing some? Because I'm $1.50 or whatever in the money on this thing. I'm in a win-win situation. If the whole thing gaps down tomorrow, if it trades lower, if this low fails for whatever reason tomorrow, I will still make money in it, but I'm going to keep 25% of my position, 15% of my original position, something small like that, just in case this RDR leads to a snapback to bigger time frame equilibrium. That same stuff that I was talking about when I was on the radio earlier, and even earlier today, about how equilibrium works on multiple time frames, still applies here. This ADMA on the daily chart is going to continue to move lower because it's a moving average, but you are looking at a need for some sort of price or time correction in this stock. in a best case scenario, it's a full-on price correction. And that gives you a move maybe back to $67 or so. And now all of a sudden you just came in and you took a trade for 10 cents worth of risk. You get that move up to $67 or 67 and change as this ADMA is moving lower over the course of the next day or two, especially if you can get some market cooperation. And next thing you know, you're sitting here and you're $4.50 in the money, let's just say, off your 10 cents worth of risk. Now you're starting to get into the realm of what I call overwhelming reward for risk. And if you can get that overwhelming reward for risk, even just once in a while, it just pays so massively. And all that is, by the way, is a counter-trend price snapback to the ADMA on the daily chart. It happens all the time. I'm not even talking about a best-case scenario. A best-case scenario, if you really want to build out a best-case scenario, and obviously, you know, the further I build this out from this best-case scenario perspective, the lower the probability of it actually happening is. But again, you don't need it to be a tremendously great, you know, probability if it just happens every once in a while. I'm already talking about $4.50 worth of reward off of 10 cents worth of risk, potentially. That's phenomenal risk reward. Well, you know, what if you get a snapback to the ADMA on the daily chart and then it, you know, holds in there for a day or two or pulls back to 66, creates a little bit of a higher low, breaks above that ADMA, works its way up to the 21 EMA, which maybe at that time is near this high, so you're looking at a move to now somewhere between 69 and 70. The buyback starts to kick in, and eventually this thing gets back above $70, and now it's looking like a bigger picture failed breakdown on this daily chart as buyers really come in and support this thing, and now you're back within that range, and eventually that range breaks out to the upside, and you get a range break of $76, $70, $78, whatever it is, and next thing you know, you have the stock back at 90. What I just described is pretty low probability, but it doesn't matter, right? You just capture that every once in a while on 15 to 25% of your core position, and next thing you know, you just took stock for 10 cents worth of risk at whatever I just said, 62.80 or whatever, and you've still got this thing when it's at 90 bucks. And I'm saying it over and over again, it's a low probability situation. I've had that happen to me, that low probability situation, plenty of times over the course of my career. And it's not like a zero probability. Like what I just described, that entire situation, you could put 5% on that. But again, 5% move to $90 over the course of, now you're probably talking about being in this swing position for a month, utilizing a daily chart trailing stop, something like that, as that reversal, you know, plays out, and now you go from a counter trend trade to actually being with the trend and just trimming and trailing, or if you don't have a ton of stock, I guess just entirely trailing, and you get that, you know, 5% chance of that entire situation playing out, and then you can look at this thing and be like, wow, I just got $30 worth of reward off of 8 cents worth of risk on the initial trade. And that's where I've made really big money with my own trading over the course of the years, is in these lower probability situations when you get that stock and then you sit in it and you be patient with it, and especially if you can have size, right? You know, if you can do that with you know, 1,000 shares and capture that entire move, you know, we're starting to talk about some real money here. So, and maybe not everybody's at the point yet where they're taking size like that, or they can hold size like that, or that's what their positions look like. But, you know, think about it. And even if you're just doing it with 100 shares here initially, it's still good money, and it's still part of your learning process, and eventually you build into doing that stuff bigger and bigger over time. So that would be the thought process on that. I was definitely annoyed at myself for missing this PayPal, and I almost had to tell myself, like, relax, almost stop looking at it, because I'm not going to do anything with it after missing the initial trade. And that's pretty much it. So that's pretty much all I got for you guys. Again, the point here, I guess, of this meeting, we're going to keep on ranging in the free world, is ranges within ranges, but every day by focusing on names in play, focusing on relative strength and relative weakness, we've been able to do a pretty good job finding good cash flow opportunities within a market environment that's been, a month and a half of kind of chop and obviously has led to nothing. So we'll keep monitoring that big picture situation because eventually it will break out. And until then, we'll just keep doing as we've been doing. I just, I'm a little bit nervous. I don't know if nervous is the right word for when we come out of earnings season, that I'm not going to have as much to focus on, and that's when it gets a little bit tougher. And you also just want to make sure that you're not over trading and churning when opportunities aren't there and when you don't have an advantage. Because if there were no earnings names today, even PayPal is a special situation that's caused by an earnings report, right? So there could easily be a time when we're outside of earnings season and those opportunities just aren't there. It can be very hard sometimes for a trader to just sit on his hands. Obviously, we'll try to find them, but you really want to make sure that you're not forcing trades when they're not there. And right now, we've had some good trades every day. So with that said, happy to take a look at any questions that you guys have. First thing here I'm seeing is from DJ. Hey Dio, if an RDR gives super tight risk like 1 to 3 cents, do you give your stop a little more room? People love to ask that question in case it pokes a new low before the trade starts working, or do you let it stop you out and look for a re-entry? That's what I do, or potentially give up on it. Yeah. I need to have a trade set up in order to get back into something, and I've always disliked the random risk stuff. What I do, just to be fully open and honest, what I do sometimes is, and by the way, I don't recommend this, especially if you're a newer trader, and I've talked about this in the past. Sometimes it's hard for me to balance. When I'm working with a big group of people, some of you guys have relatively small accounts, some of you guys are working with millions of dollars. It's hard for me to balance the right things to say to every single person all the time, and sometimes what I do is a little bit different. I don't want to say contrary, but a little bit different to what I would teach is the right thing to do. So you need to understand your own trading, your own risk tolerance, how sizing works for you, and things like that. But what I will do sometimes, like I did with this Alibaba, is I won't have a hard stop loss in. But if I don't have a hard stop loss in, I also can't have big size. If I've got big size, I really need to know exactly where my stop loss is going to be, so I can be purely measuring that risk. If I've got just a few hundred shares, and I'm thinking I need to give it $1 worth of room, for me, if that dollar is $1.50 or 75 cents, that's not going to be a big difference for me in terms of dollar risk for the sizing that I'm working with and the account size that I'm working with. But for somebody else, the difference between 300 shares, 75 cents till you're getting stopped out, $1.50 till you're getting stopped out, could be really important for you. And you need to understand that for yourself. So for me, I'll take these types of trades where, all right, I've got very little size here and I'm giving it room, but if it's a trade like what you're talking about with this RDR situation, where I've got this very specific setup and that risk is going to be tight, I'm putting that stop loss in. So, and what I don't do in those situations is give random amounts of room. And even in this Alibaba, I'm not giving a random amount of room. I just don't have a defined stop yet, because I need the stop to present itself to me. And that could be, a price correction down into the 80 MA and then a pivot, and okay, and now the stop has presented itself to me and I know exactly where that stop loss needs to be, and maybe I'm getting even heavier off of it. But I still need to actually have that trade setup kind of come in. So when you're looking more at this PayPal, my trade setup here is very clear. I'm buying it back through the previous day's low versus whatever low happens. To the point where my plan when I was watching it in this first 5-minute bar before it came off my radar was going to be the second this thing basically ticked a penny below yesterday's low, I was going to put a buy stop for a penny above yesterday's low. So in other words, if yesterday's low was 78 cents, the second this thing that was 77 cents or lower, I was going to put a buy stop at 79 cents. to actually buy stock back through, and then monitor it. And at first, that buy stop might be on big size because the sizing, the space is going to be such a little amount, right? So, you know, I'm gonna have however many thousands of shares there because it's such small risk. And then if I see that continues to really deteriorate, or all of a sudden it's not 8 cents worth of risk, it's 50 cents worth of risk, then I'm gonna adjust that buy stop potentially accordingly, or I might cancel that buy stop entirely at that point and look for a different entry setup with the background thought process that I'm still looking for the RDR to come in, but I want to be able to try to find that smaller time frame risk. What I'm not going to do is see the 64 low come in, buy stock, and then, you know, my stop loss is going to be 62.63, a penny below that low, a penny below the pivot. What I'm not going to do is put a stop loss at 62.59 or 62.55, or just make up some random number below the actual pivot to give it a little bit more arbitrary space just in case. I don't like that because you can't create rules around it. And your trading should have rules with everything that you're doing, and I just don't like it because it's arbitrary. You know, you choose to go 59 cents and the low is 57 cents. You choose to go 55 cents and the low is 52 cents. You know, and then next thing you know, it becomes a very slippery slope to no risk management at all. Well, I did my stop at 55, I went to 52. I knew I should have used 49. Well, I did my stop at 49 and went to 47. I knew I should have used 39. You know, you just like kind of can go down that slippery slope. So if I'm taking that trade, I'm putting the stop in. If the stop triggers, then I'm not getting back in unless a new setup actually presents itself, and a new specific trade setup actually presents itself. Back through I would use yesterday's low at this point. The only way I'm using, and let me just, I guess, read out loud the second half of your question. Also for PayPal, if you're looking for an entry 935, do you think you would have been better to buy back through the low of the 930 candle or back through yesterday's low? In this case, I'm using yesterday's low very specifically. I don't think that the first 5-minute bar low matters. In this case, it's only one candle. One thing that I have been doing more of, which is a little bit newer for me, and I've been talking to you guys about it over the course of the last few months because I've been doing it with a good amount of success, is I've been doing like what I've been calling like a 5-minute RDR trade, and where it's the same principle. You get like 3 really heavy red bars in a row, and I talk about it sometimes. I'm trying to remember what stock I was talking that we saw kind of crashing down at one point this morning, or maybe it was even the market. Yeah, I don't remember what I was looking at today, but at one point today in one stock that was kind of crashing down, I remember looking at it. Was it Semi? I think it was it. This NVIDIA is a good example, though. I don't think it was NVIDIA, but this NVIDIA is a good example. And maybe it was NVIDIA. I honestly don't remember. One of the things I have been implementing is like a 5-minute chart RDR when I understand time of the day and degree of extension. You get like these 3 real heavy red 5-minute candles in a row here that's creating downside extension. That's a healthy amount of downside extension, especially for 10:40 a.m. Because again, we know our time frame rules, right? It's much easier for a 5-minute chart to be extended to the downside at 9:35 and become even more extended than it is at 10:40 or at noon. And that's where your 15-minute chart at 10:15 plus becomes significantly more important. So I love the idea of like, wow, 3 big red bars in a row here. At this time of the day, you're getting really healthy downside extension. I know it's also broadly like a support level on the daily chart. On this 4th candle, if this 4th candle could have broken the 3rd candle's low and snapped back, I would like this as a trade back through the 3rd 5-minute bar low versus whatever the low is of the 4th 5-minute bar for looking for a snapback to the 80 MA on the 5-minute. You don't get it here. It never breaks that low. But I'm starting to look for that trade, and I've been implementing that trade, and it's been pretty successful for me. So I'm not going back to PayPal, one 5-minute candle in a row here is not giving me enough. It's not giving me enough extension. I'm not looking to go long back through the last 5-minute bar low. At this point, I'm still very specifically focused on that daily chart. Now, if I could have gotten, and I would love this too, I had just mentioned to you that if this thing continued to really sell off, and now all of a sudden instead of 8 cents worth of risk on the daily chart RDR, I'm looking at 50 cents plus worth of risk, then I might be looking more at what we were just looking at NVIDIA, but with PayPal. Meaning, if I could have gotten, what's the sizing of this first 5-minute candle? It's 80 cents. Give me 3 of these in a row. So this bar closes at 62.70, let's call it. The next bar closes at 61.90. The third bar closes at 61.20. On top of that, I know it's the third down day in a row, and I've got this massive extension on the daily chart. I'll probably be asking Pat, hey Pat, what's that 5-minute RSI look like? Because that's an extra layer of probability that I've been looking at with these extension trades recently. And now I'm probably going to look to take the trade I just described in NVIDIA, that like 5-minute RDR, take that long. But going back to what I was talking about earlier about small time frame risk for big time frame reward, what I'm saying to myself when I'm taking that trade isn't just, hey, I'm taking this 5-minute RDR. I mean, I am, and I'm going to get my risk covered on it for sure because it's a counter trend trade, and whenever I'm taking counter trend trades, I have a less aggressive, less greedy game plan because the nature of a counter trend trade means inherently it has a very high probability of eventual failure. But the other pieces of information, the other layers of probability that I'm looking at are, all right, well, if this 5-minute RDR can cause a big enough of a snapback that gets it back through yesterday's low, now I just took, again, a 5-minute time frame trade that just became a potential daily chart time frame trade because it just RDR'd on that daily chart. And now I got the same reward potential with even better pricing and even better risk reward. Right, I just bought this thing now at whatever I just said, 61.20 on the break back up of that, third massive red 5-minute bar. I got extension on multiple time frames. I'm taking that long, and the exact same reward profile could potentially play out if it gets back below yesterday's low. So, hope that helps. P.S. Usually can't stick around for the afternoon meeting, so may need to drop off. Drop a question, disappear from time to time. Okay, yeah, no problem. Cool, sounds good. Smash that like button. I love it. From David Dean. Does SoFi trade differently than... Yeah, it sure does. It seems like it's in a world of its own. Does SoFi trade differently from other stocks and ETFs? I was rejected while putting in limit orders to sell short, and even rejected as a market order. My brokerage is Schwab. Get a better brokerage. I would recommend reaching out to T3. We've got retail accounts. We've got prop accounts. We got this other company called T3 Global that has accounts. I would recommend getting with a better company. SoFi is easy to borrow. You should be able to just whack the short button, hit your sell button, and get short whenever you want. Yeah, none of that should get rejected. So that'd be my feedback on that. But does SoFi trade differently than other stocks and ETFs? Not in that regard about selling short and market orders. It seems like it trades differently in regards to some of these things just doing whatever it wants. Like sometimes it trades like a bank. Sometimes it doesn't trade like a bank. Sometimes it trades like a growth stock. Sometimes it doesn't trade like a growth stock. There are times I don't understand the weakness in SoFi today. I have no idea why it was down 6% unless it was just technical. Had that earnings report that I thought was decent, but they sold it off super heavy. Eventually gave a big oversold bounce. Probably got hit even harder because of the regional bank stuff. Eventually gave a big oversold bounce. I thought it was looking really good over the course of the last couple of days. I was trying to hold back above 550. I thought this thing was actually going to start working its way higher, and then just out of nowhere today had this massive failure. You could compare it to KRE, which is down 2.5%, but this thing's down 6%. You could compare it to like an ARC, which represents more growth, but that's positive. So I don't know. SoFi completely in its own universe. Maybe it was just technical in nature. I didn't see any news, but a little tricky for sure. From Denver Steve, when is someone going to buy Peloton? Can't get much cheaper. Yeah, so Peloton has been on my list, and I've had this list for a while now of stocks that I think could get bought out. and it would just make sense. And at one point, and it's been a while, back in February 2022, when this thing was in the 30s, there was chatter about a Nike buyout. I always thought that this could be a good Apple purchase, like, or you know, any company that sells tablets. Like, imagine if you're getting on your Peloton and you know, every single screen was actually an iPad, or you know, Microsoft's equivalent or Google's equivalent or whatever. Yeah, so I felt for a while that, you know, as a standalone company, this thing might have some problems. There was some real mismanagement at a certain point by the executives. But it's also a recurring revenue business model, and those tend to get higher multiples just by nature of the business. So there's a lot to like here, and I thought someone could you know, maybe not as a standalone business, it's ideal, but could be really accretive to someone in a buyout. But it hasn't happened. So, and that chatter from Nike and was it Amazon back in February 22, you know, we're quite a long time after that. No one's talking about it anymore. But I still have it on my list. But you never know. Whenever you're talking about potential buyouts, it's always speculative. I've got DocuSign on that list. I've got Roku on that list. So we'll see what happens. What's up, Judy? From Eddie Vic, what do you think would be a proper leverage ratio per trade? Guess it depends on how confident each trade is, but generally for new traders like me, would it be 1.5? Would it be 2? Would be a good starting point. It's not how I view it. I don't view it as you know, leverage per ratio trade, you know, that you're looking at. The cool thing about being a prop trader, as opposed to being in a retail account, is that you never have to worry about how many dollars it costs to buy stock. The equation that you're worried about is the risk. So I think that the real question that you should be asking is not the proper leverage per trade. It should be, what's the appropriate percentage of my account that I should risk on a trade? And the answer to that will also be variable. I think that traders should create what I call a risk skew for themselves. First of all, you give yourself a maximum daily loss. That maximum daily loss should be a small percentage of your account. I don't know, 2%, 3%. If you're aggressive, maybe as much as 5%. And then that you have that number. I always like to use simple numbers. It's called $500. And then off that $500, you create a risk skew for yourself based on risk-reward probability of success. And then you can give trades a letter grade off of that. So like an A, like in school. So an A+ trade is a trade that's got a, you know, phenomenal risk-reward, and all the layers of probability that we like to look at are on the side of that trade. And that would be a trade where maybe you consider risking. Why is my wife calling me? Text her. In the meeting, is everything okay? Yeah, so as I was saying, you give yourself this daily risk, and then you give yourself a risk skew grade set, where maybe that rare A+ trade is worth your entire day. So if your entire day is $500, then you should risk that entire day on that one trade. But that's going to be pretty rare. And then maybe your average, you know, B-type trade is, you know, half of that, or even less than half of that, a couple $100. So you could take, you know, 2.5 opportunities of B-level trades, and if they all fail, then you're done for the day because you're past your maximum loss. So, you know, the ratio, the leverage ratio doesn't really make as much, you know, it doesn't really matter as much, because you look at like a PayPal, where PayPal, you're coming in for, let's call it 8 cents worth of risk, and you know, if you want to take $500, well, you won't take $500, I guess, off of that, because you're probably not going to consider it to be an A+ trade. But I don't know, whatever. You know, if you want to take $250 worth of risk on that, then you're taking like 3,000 shares. Well, 3,000 shares of a you know, let's just call it $63 stock, it's $190,000 in buying power. That could be a trade that you could take with $10,000 in your account, but you're using a tremendous leverage ratio on it, right? It's very appropriate, in my opinion, for a trader with 10,000 bucks in their account, if they really liked this trade and they graded it solidly, to risk $250 in it to take, which would be about 3,000 shares, which is $190,000, but that's almost 20x leverage just on one trade, right? But in this case, it's very much appropriate. If this thing was 50 cents worth of risk, taking 3,000 shares on a $10,000 account is going to be $1,500. Now you're risking 15% of your entire account on the one trade. It's no good. It's no good. So that's I think the way that you think about it. From Jordan, what gives you confirmation to add to a position? I was thinking about adding an Amazon at the 10:30 pivot. Okay. But I didn't have the confidence yet. So I just let my win-win trade ride, which is fine, but curious to see what you do. Sure. So I don't like adding up onto a pre-existing trade. I really don't like doing that. That will mess up the average price on your trade. It can mess up the way that you're trailing it, which isn't to say that I don't add to positions sometimes when they go higher, but the way that I always do that is a completely separate trade. So if you've got stock, whatever, let's say that you bought the intraday breakout here at $111 and you took 30 cents risk on that trade versus the low of that bar or whatever. Trade's working out really well for you. And now you're taking a new trade at a higher price. And this trade's working. I will never let's say this trade fails, but the stock keeps going. I will never let the failure of the secondary trade, which is a pivot trade in this case, which I don't actually like this trade because you don't have, I want to see either an inside 5 or 15 and up or a continuation hammer here, and I don't have either of those things, so I wouldn't actually take that. But if you did, and then let's just say that shakes out and then still goes up, I'll get stopped out of this trade and I will lose my risk in this trade, but I will not get stopped out of the core position that I have from the original trade. I separate them. And the thing that traders I see struggle with on that is that the average price on your software, your trading software, gets messed up. So like, you just let's just use simple numbers. Let's say you risked $100 on the first trade, you risked $100 in the second trade. First trade's working out really well. You buy this stock here and you risk $100. When you get stopped out of this, your software may show you selling stock really for a loss on what you just bought at a profit because it's higher than how it's calculating the average price. So that can mess traders up. But if you really do the math on it, it's going to end up being the exact same on if you view that as a win somehow versus, and then you eventually get like stopped out of that or you get stopped out of the original trade. Like the P&L will be the exact same if you did it that way versus if you split it. And I'm probably not explaining that very well. I'm probably not explaining that example really well, but if you play with the numbers, you'll find it's just accounting math, and it actually doesn't actually matter. So that's how I always do it. If I'm buying more stock at a higher price, it's almost always, in my brain, going to be treated as a completely separate trade with completely separate risk. I got my $100 worth of risk here. I don't care what my machine says. I have my $100 worth of risk here, and that's just it. I'm not letting this affect this. The worst thing that can happen is you get shaken out of this trade, and then this thing closes at $116 today, and you didn't keep the remainder of your stock because you let your average price stuff get in your head because you lost $100 on a secondary trade. So I hope that makes sense. I would say play with the numbers a little bit today, and if it still doesn't make sense to you tomorrow, give me a follow-up question in tomorrow's afternoon meeting. Is tomorrow Friday? Yeah, tomorrow's Friday. We don't have an afternoon meeting tomorrow, but you can just ask me during the day on the VTF or shoot me an email or whatever. Anybody else have anything for today? I think this is a pretty productive afternoon meeting today. Okay, I'll wrap it up. Great stuff today, guys. I think that you guys did great. Involved in the right names. Pumped to see that PayPal was like a magic carpet trade with how many people were in it and did well with it. Hope some of you guys are swinging it, and I hope that works out. I'm upset I didn't capture it, but I was in some other good stuff. So have a great night, everybody. I'll see you all tomorrow.